Imagine you're trading stocks or currencies with borrowed money from your broker. That borrowed money is called margin, and it lets you control a larger position than your own cash would allow. But this leverage is a double-edged sword. If the market moves against you, your losses can quickly eat into the money you put up as collateral. A margin call is the broker's way of saying your account has dropped below the required minimum value, known as the maintenance margin. Your broker will demand that you deposit additional funds or securities to bring your account back up to the required level. If you don't act fast, they have the right to liquidate your positions. The trigger is not just any loss, but a specific threshold. Every brokerage firm sets a maintenance margin requirement, typically around 25% to 30% of the total position value. When your equity falls below that percentage, the call goes out. The broker is protecting themselves from the risk that you won't be able to cover the debt. When the call happens, you usually have a very short window, often just 24 hours or even less, to comply. You can either wire cash into your account or sell some of your holdings yourself to free up cash. If you do nothing, the broker will step in and start closing your trades, often at the worst possible prices. The real danger of a margin call is forced liquidation at a loss. The broker is not trying to get you the best price, they are trying to cover their exposure as quickly as possible. This can lead to a cascade effect where your assets are sold at fire sale prices, wiping out your original investment and potentially leaving you with a debt to the broker. To avoid this, always know your position size relative to your total account value. A good rule of thumb is to never use maximum leverage. Keep a healthy cash buffer in your account so that a normal market dip doesn't trigger a call. Understand that a 10% market move against a highly leveraged position can wipe you out entirely. You can also set your own personal stop-loss orders well below the broker's maintenance margin level. This ensures you exit a losing trade on your own terms, preserving most of your capital. The goal is to never be in a position where the market can force you out at a catastrophic moment. The simplest way to avoid a margin call is to trade with cash you can afford to lose, and to treat leverage as a powerful tool that requires constant respect. Never let greed convince you that volatility won't touch your positions. If you manage your risk carefully, you will survive to trade another day, which is the real secret to long-term success.